Let's switch across to the macros. Chetan Ahya of Morgan Stanley joins in. Hi Chetan, morning. Before anything else, Thursday will be IIP data. What are you expecting to see?
I think it will probably be another month of zero to negative industrial production number.
Morning, Chetan. There's been a lot of talk that Q4 will be a quarter of rebound after a horrific Q3, and there have been a few data points which suggest that it might indeed be a bit better on fronts like cement and auto. Are you expecting any meaningful GDP rebound in Q4?
I think there will be an improvement primarily because of the fact that the agriculture was very bad in the third quarter. And assuming that that will improve in the fourth quarter, you should see an improvement in the GDP at the headline level. But the underlying fundamentals, I don't think are really going to show any improvement just because auto has rebounded on a low base of February. I don't think really across the board there is that kind of an improvement for us to say that the GDP would be bottoming out and the bottom would have been behind us. I think the bottom is ahead of us.
That agri number actually took a lot of people by surprise, Chetan. Did you see it coming, and do you think there is a likelihood that maybe even in Q4 there could be a surprise from that front?
Yeah, I think there are two reasons why it was a surprise. I mean, two reasons why it was low. One is that there was some base effect. So last year, same quarter was above 6%. So there was some bit of base effect, which is not there for the fourth quarter. Secondly is that you also have a situation where the numbers in the end, when they totaled up, the final food grain output was pretty low. So I think both these factors should be more supportive. What they do for the fourth quarter is also try to average it with the quarter ended June output. And this is more like the winter crop output. So I think the fact that the food grain volume numbers would be better, at the same time you won't have the base effect. I personally think that the agriculture number would be better than what you saw in the third quarter. But I think, that's not really what really matters from a market's perspective. From the market's perspective, the question is whether the GDP numbers have bottomed out on a trend line basis underlying, and that we don't think so. We think it will bottom out in the quarter ended June and quarter ended September. We expect the similar kind of number of close to 3.5–4% GDP growth number for those two quarters. This is for June 2009 and September 2009 numbers. So the bottom is ahead of us, and that's what really matters, I guess.
So you're saying Q1 next fiscal and Q2 next fiscal average 3.5–4% GDP growth. What happens after that in your eyes? Do you see any turnaround starting Q3?
Q3, as I mentioned, will be more or less the same as Q2. This is financial year we are talking about now. The quarter ended December, which is the quarter ended December 2009, is when really we expect things to start bottoming out. Also, there will be a support of base effect from that quarter onwards. And our house view is that the world starts improving in from that quarter as well. So I think it will be base effect in our numbers, as well as the fact that the rest of the world starts showing some signs of improvement. We are hoping for growth to start bottoming out from that point of time.
We've talked in the past, Chetan, about the stress you expect to see from the banking sector. For the rest of this calendar year, how do you think things will shore up, both in terms of what kind of credit offtake they have and how high or bad NPAs get?
We're expecting non-performing loans to rise to 7–8% by March or 11 financial year. Mind you that this is more like underlying non-performing loans. There are changes in regulations which will make banks defer showing this as NPLs. But the underlying, for which I would take the restructured loans as well, would probably be easily 7–8% by March or 11. As far as the credit growth is concerned, we're expecting it to go down to 10% by December 2009 from current 19.5%, primarily because the banking sector is expected to get more risk averse while lending to the borrowers. And at the same time, the genuine borrowers and the ones which have the balance sheet will be holding back their investment cycle. So the combined effect of the fact that the guys who are good in their balance sheet will be hesitant to borrow, and the guys who want money, the banks will be hesitant to lend, you will see the credit growth coming off to 10%.
Just map the demand picture for us, Chetan, for 2009, because on one hand, the kind of stimulus that public sector employees have got is leading to some kind of a demand spurt. How much of that you think will be offset by things like job cuts in urban India? Because they seem to be the opposing forces. One has got more money to spend and probably another section has much less.
I think basically what we have to view is that the government expenditure helps us prevent the bottom to be not as low as it would have been otherwise without them. But it doesn't help us change the direction of the cycle. And we think that the direction is still continuing to go down in the next 4 to 6 months because of the tailwind that we have from the whole global down cycle. Just for example, the export numbers even for the latest month that we're hearing is likely to be again year on year. And the most important thing is that the private sector, the vibrancy of the private sector was coming in from the capex side, which was growing at a phenomenal pace. And that is going to retrench pretty badly. And the negative effect of the private corporate capex will be very hard to fill in by the government expenditure. So our view is that the government expenditure helps, but it doesn't change the direction of the cycle. And you are still going to see a lot of pain in the economy from the fact that the investment cycle is going to retrench pretty badly.
There's been quite a bit of debate about where yields may head, Chetan. One camp believes that it's going to harden, the other saying that risk aversion to equity will continue and appetite will get dumped basically on the bond market. Where do you see it headed?
Well, it's a tough one, I agree. But I would bet on the fact that the 10-year yields first go down before they go up. So it's a trajectory that you will have to imagine that in the second half it probably moves up back again. But in the next 3-4 months, you could see the 10-year moving down because of the fact that the credit growth is going to come off sharply. And at the same time, the oil subsidy burden has gone to close to zero. So even while the tax revenue is falling and the government is increasing its expenditure, we have these two other forces, which is credit growth decelerating and oil subsidy going away, supporting the domestic liquidity environment. So I would bet that the 10-year will probably go to 5.5 first before it rises back to 7.
Always good speaking with you, Chetan. Thanks for stopping by this morning with your thoughts. Morgan Stanley on what to expect both from the IIP and the GDP. We're going to take a